Okay, picture this. It's a breezy Tuesday morning. It is February 2026. You're in Stuart, Florida.
Mm-hmm.
Maybe you're grabbing a dark roast at a cafe on Osceola Street, or you're walking down Colorado Avenue.
Yeah.
The sun's out, the palm trees are doing that gentle sway thing. It looks, pretty much like paradise.
It does, but if you were to listen in on some of the conversations happening, say, in boardrooms or at the local country clubs, the vibe is, well, it's shifting.
It's definitely shifting. And for once, no one's talking about the humidity.
Right, not about the weather.
Exactly. There's this quiet exodus happening right now in Stuart's wealth management scene. And just to be clear, we're not talking about a market crash
No, not at all.
or some big Ponzi scheme making headlines. It's much subtler than that, but maybe even more significant for the local economy. Executives from places like Seacoast Bank, RSI, that whole tech corridor on PGA Boulevard, they are quietly firing their big box brokers.
Which is a massive disruption. I mean, you have to understand, these are people who have probably been with the big national names, the Merrills, the Morgans, for decades.
Sure, for their whole careers.
Yeah, and in finance, inertia is it's the most powerful force there is. People will stay with a bank they don't even like just to avoid the paperwork. So if they're moving, they have a very, very good reason.
And that is the mission for this deep dive. We really need to unpack the why now. Is this just about saving a few basis points on fees, or is something more fundamental breaking down here?
To get to the bottom of it, we're digging into a report called the 2026 Big Box Breakup by Davies Wealth Management. And they've done this really forensic analysis of the triggers that are driving wealthy families away from the wirehouses and toward independent registered investment advisors, or RIAs.
Right. And the report frames this whole shift around three pillars: the service, the math, and the location. But let's start with the human side of it. The report calls it the catalyst. Because, let's be honest, people don't usually leave a 20-year relationship over a spreadsheet. They leave because they're angry.
Anger is almost always the spark. Yeah, it's that feeling of being completely taken for granted.
So there's this anecdote in the source material about a CFO at a local manufacturing firm. Now, this is a guy who gets numbers. He's not new to this. He was with Morgan Stanley.
Okay.
And the report says that in the entire year of 2025, his advisor called him exactly twice.
Twice. That's minimal, to put it lightly.
It gets worse. Both times, the call wasn't, hey, how's the family, or how's the portfolio doing? It was to pitch a new product.
So it's transactional, not relational. That tells you everything you need to know right there.
Right. But here's the context that makes it so bad. This CFO's company had just gone public.
Yeah.
So his equity compensation, stock options, RSUs, it jumped from around $200,000 a year to $1.8 million.
Yeah. Wow. Okay, that's a life-altering event.
A massive life change.
Yeah.
Huge tax implications, huge concentration risk. And yet, his asset allocation, it hadn't been touched since 2022.
That borders on negligence. If your client's income goes up 9 times in a single year, the entire plan needs to be torn up and rewritten. You have tax brackets, estate planning.
Right.
Everything changes.
Exactly. And when he finally called his advisor to ask about tax loss harvesting, basically asking, how do I not get killed by the IRS? He got that classic, we'll look into that, and then
Radio silence.
radio silence.
And this really highlights the fundamental flaw in the wirehouse model, which is something the Davies report just drills into. It's not that the advisor is necessarily a bad person.
Right, not lazy or anything.
Not necessarily. It's that the system isn't designed to service that client. It's designed to sell to him.
Unpack that, because I think most people assume that if you walk into a big bank with a marble lobby, you're paying for premium service.
You're paying for premium marketing. It really comes down to incentives. The source points out something they call product quotas. Now, the industry will tell you these don't exist anymore because of regulations. But the report finds that even now, in 2026, 67% of wirehouses still tie a big part of an advisor's compensation to selling proprietary products.
Wait, 67%. So 2/3 of the time, your advisor's bonus actually depends on selling you their company's fund, not necessarily the best fund on the market.
Precisely. They are incentivized to gather assets and sell specific things. They are not incentivized to do the complex, unglamorous work like tax planning or rebalancing a portfolio that's already there. Selling a new product gets them a commission. Rebalancing just generates paperwork.
That totally explains the pitch calls then. The advisor needs to sell something to hit their number.
It also explains what the report calls relationship creep.
Oh, I highlighted this section. This is the old bait and switch.
It is. It's a classic move. You sign up with the senior advisor, the person with the impressive title, who you meet at the country club. They wine and dine you, but 6 months later, every time you call, who do you actually talk to?
A junior associate.
Or a team member.
Or worse, a call center.
And the person you actually signed up with.
They're off chasing bigger fish. The source says the person who knows your situation often gets promoted to handle larger institutional accounts.
Yeah.
So you're left with someone who is, basically learning the ropes with your life savings.
That feels like a betrayal, doesn't it? You hire a person, not a logo.
But in that big box model, you are buying the logo. And that leads us straight to the second pillar of this breakup. Because bad service is annoying, but bad math, that's expensive.
Let's get into the numbers. The report draws this hard line between two terms that sound like legal jargon, but are actually the difference between retiring at 60 or, 65. Suitability and fiduciary.
Yeah, these are the rules of the road. And the big box standard is usually suitability.
What does that actually mean?
In the real world.
It means the advice just has to be suitable for you. Think of it like buying a suit. If you're a size medium and the salesperson sells you a polyester suit that fits you, but it costs $5,000, when there was a high-quality wool one right next to it for $500.
Okay.
Under the suitability standard, that's perfectly fine. The suit fits. It's suitable.
Even if it's a total ripoff.
As long as it fits your general risk profile, yes. The source gives a great financial example. An advisor can legally recommend a mutual fund with a 1.2% expense ratio and a 5.75% front-end load.
Let's pause on front-end load. That's a commission, right? Off the top.
It's an entry fee. You invest $100,000, and with a 5.75% load, only $94,250 actually gets invested. You are down almost 6% from day one.
And they can sell you that even if there's an identical index fund for, 0.04% with no load?
Yes, because the expensive fund is still suitable. It invests in stocks. You wanted stocks. The fact that it makes the broker a lot more money doesn't make it unsuitable under the law.
That's wild. Okay, so what's the RIA standard then?
RIAs operate under the fiduciary standard. This is a legal obligation to act in your best interest. So in the suit analogy, a fiduciary would have to tell you, hey, that polyester suit is way overpriced. Buy the wool one for $500, it's better quality, and saves you $4,500.
So under a fiduciary standard, they literally cannot sell you the junk just because it pays them more.
Correct. It requires total fee transparency, best execution, and they have to disclose all their conflicts. If they make money from a recommendation, they have to tell you how.
Okay, let's put some real money on this because the Davies report has this case study of a Martin County executive that's it's eye-opening. This guy thought he was getting a great deal. He actually told them, I don't pay advisory fees. My broker only makes money when I make money.
Ah, yes, the fee-free myth. It's one of the most dangerous misunderstandings in all of finance.
Spoiler alert, it was not free.
Not even close. When the independent analyst looked under the hood of his portfolio, this executive was holding 18 different mutual funds.
18. That seems like overkill.
It's what we sometimes call diversification. You own so much, you're just paying a ton of fees to basically mimic the market. But the real issue was the cost. Most of these funds had front-end loads between 3.5% and 5.75%.
So every single time he put money in from his paycheck, the bank was taking a 5% cut.
Correct. Or every time the advisor rebalanced from Fund A to Fund B, that could trigger a new commission. And it didn't stop there. The internal expense ratios averaged 1.14%. And then you had the 12B1 fees.
I looked this up. 12B1 fees are for marketing. You're paying for their ads.
Essentially, yes. You, the investor, are paying a fee out of your own returns to pay for the fund's advertising and to compensate the broker for selling it to you. It's an annual recurring cost.
So you're paying for the commercial that convinced you to buy the thing you already own.
It's a legacy fee that just refuses to die in the big box world. So you add up the loads, the expense ratios, the 12B1 fees.
And the total annual cost was about 2.1% of his portfolio.
2.1%. And remember, he thought he was paying zero.
So compare that to the typical RIA model.
Well, for a portfolio over $1 million, the advisory fee is transparent, usually around 0.75% to 1.0%. And the institutional funds they use, they average about 0.15% in expenses with zero loads and zero 12B1 fees.
So you're talking about cutting your cost by more than half.
More than half, yeah. On a $3 million portfolio, the difference between paying 2.1% and, let's say, 1% all in is about $33,000. Every single year.
That's a new car. Every year, that's a luxury vacation.
And that's just the cash flow. Over 20 years, that $33,000 a year compounds. You were talking about hundreds and hundreds of thousands of dollars in lost wealth. That is the difference between building generational wealth and just, doing okay.
It's staggering. It's not just fees. It's years of your life you're working just to pay someone else's commission.
Precisely. And that realization, that's the math pillar that's driving this whole exodus.
But there's a third piece to this, and it's very specific to where we are. We're calling it the Florida factor, because Stuart is not New York City.
Geography is strategy. And the source makes a great point here. National firms have a standardized playbook. It works okay for the average investor, but the wealth in a place like Stuart comes from very specific sources.
Right. It's not just retirees anymore. It's business sales, regional execs, and that huge wave of remote tech workers moving down.
And that creates a level of complexity that a boilerplate 60-40 portfolio just can't handle. Take equity compensation. The report mentions employees at places like BioReference Labs and Seacoast Bank.
Yeah, if you're getting RSUs and performance shares, that's complicated stuff.
It requires really granular planning. You need to know which tax lots to sell. Do you sell the shares that vested yesterday or the ones from 3 years ago? A lot of big box advisors just aren't trained for that. They just say sell it and diversify. But if you sell the wrong lot, you might pay 37% in tax instead of 20%.
There's also the whole issue of where you live. Or, more importantly, proving where you live. The domicile rules.
This is huge for anyone who's moved to Florida from a high-tax state like New York or California. You can't just buy a condo in Stuart and call yourself a Floridian.
The dreaded residency audit.
Exactly. Those states are aggressive. They're losing revenue, and they fight for it. The report talks about the 183-day rule, sure, but it's deeper. They look at where your dog is registered, where your primary doctor is, where your most prized possessions are kept.
Seriously, they look at where your dog is registered.
They look at everything. It's about your domicile intent. Local RIAs in Stuart deal with this every single day. They know exactly what you need to do to bulletproof your residency, a national firm based in New York. They might not be as focused on helping you stop paying New York taxes.
And it's the network too, right? Knowing who to call.
The local ecosystem, yeah. If you're selling your business in Martin County, you need a team, an M&A attorney, a specialized CPA, a wealth manager. They all have to talk to each other. Local independent advisors, they know the local attorneys. They can actually coordinate. In a big firm, that coordination is often a myth.
Okay, so let's tally this up. You have better service, better math, and local expertise. But people are still scared to switch.
Friction. It's the enemy of improvement.
It feels like this huge mountain of paperwork. And I think people are afraid that if they leave the big bank, they lose out on the tech.
The report calls this out in a section called the tech gap. And it kind of flips the whole narrative. There's this misconception that big banks have better tech because they have bigger budgets. The report calls it technology theater.
I love that phrase.
It's perfect. They have these flashy apps, slick interfaces, but under the hood, it's often legacy code from the 90s that's been patched together with digital duct tape.
So it looks like an iPhone, but runs like a fax machine.
In terms of actual capability, yeah. The source argues these tools are built for the average person. They fail when you need to do complex things like manage concentrated stock or multi-state tax planning. Independent RIAs, on the other hand, they can choose the best-in-class software for each job. They're not stuck with some ancient proprietary system.
So the tech is often better on the independent side. But what about the actual move? I think people imagine they have to sell everything, pay a huge tax bill, and write a check.
That's the number one fear. But the reality is much simpler. It's a process called ACES.
ACES. Sounds like a sneeze.
Automated Customer Account Transfer Service. It's a standard automated system. Your new advisor handles all the paperwork. You sign a few forms. It usually takes 2 to 4 weeks. And crucially, you almost always transfer in kind.
In kind, meaning you don't actually sell your stocks.
Exactly. If you own 100 shares of Apple at Morgan Stanley, you just move those 100 shares to the new custodian, like a Schwab or a Fidelity that the RIA uses. No sale happens. No capital gains tax is triggered. It's like moving furniture from one house to another. You don't sell your sofa and buy a new one. You just put it in a truck.
That's a huge relief. So the tax hit is basically zero.
For most stocks and ETFs, usually zero. Now, there are exceptions. Remember those high-fee proprietary products we talked about?
The ones only they sell.
Right. Sometimes those funds are captive, meaning they can only be held at that one bank. If you leave, you might have to sell those. But the report argues that getting out of a high-fee, underperforming product is usually worth the one-time tax hit just to stop the bleeding.
It's like ripping off a Band-Aid instead of letting an infection fester.
Exactly. And once you switch, the whole service model just flips. You go from a phone tree to the principal advisor. You go from, we'll look into it, to proactive tax planning. For RIAs, tax efficiency isn't an afterthought. It's central to their whole strategy.
It really feels like this big box breakup is inevitable once you reach a certain level of wealth. I mean, once you see the math, you can't unsee it.
It's a maturation of the market. People in Stuart are realizing that loyalty to a brand name is not a financial strategy, and frankly, the big banks haven't really given them a reason to stay.
So let's recap the findings from this deep dive. We're seeing this quiet exodus in Stuart, Florida, and it's driven by three main pillars.
First, the incentives. The difference between a salesperson trying to hit a quota operating under suitability and a fiduciary who has a legal duty to put you first.
Second, the math. That realization that your free advice is actually costing you over 2% a year in hidden fees.
And third, local expertise. The need for specialized knowledge about Florida domicile rules, equity comp, and the local business landscape that a national firm just can't replicate.
It's a really compelling case. It's about taking control of your financial future instead of just hoping a big bank has your back.
It is. And if I could just leave the listener with one final thought from the source material, it would be this.
Go for it.
We talked about that statistic that 67% of wirehouses still tie compensation to selling their own products. I just want you to really think about what that means. The next time you sit down for a portfolio review, you need to look across that desk and ask yourself a very simple question. If this person's bonus depends on what they sell me rather than how well I do, whose retirement are they actually planning for? Yours or theirs?
That is the question. Thanks for joining us on this deep dive. It's your money. Make sure it's working for you. We'll see you next time.